webcast is now starting. All attendees are in listen-only mode.
Welcome to our 2019 webinar series. The 2019 monthly webinars will include client stories, your clients' stories, and how these stories can help you and your clients in this year and beyond. Each webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2019, loyal fans will receive 10 CFP CE credits, one for each month. Kicking off our 2019 webinar series is a presenter knowledgeable in a wide range of solutions. He's constantly monitoring the insurance and financial services industries to ensure your clients are getting the most up-to-date recommendations. In 2013, he joined LLIS with his CFP and MBA and has been leading LLIS as president and CEO since 2013. And here is Mark Maurer.
Thank you, Claudia. Thank you, everybody, for tuning in. Hope everybody's 2019 is off to a good start so far. And what says starting the year off right, like talking about insurance? Well, at least for me it does, because all year long you call us about your clients, you call us about yourselves, and we work hand in hand with you to find the best insurance fit for your clients. And for any of you who have gone through the process yourselves or gone through the process with a client, putting a policy in place is most of the time not easy. It can take a long time. There can be lots of doctor's records, lots of forms that different underwriters need. So it can be a big deal to get a life insurance policy, a disability insurance policy, a long-term care policy in place. And so us, the clients, do a lot of work to get this policy in place. And then it's all over, right? Well, not really. You have to maintain the policy. One of the simplest things to maintain in a policy is just paying the premiums. So we do a lot of talking throughout the year about different types of policies, how they might fit in with your clients. But today I wanted to talk a little bit about just, as we're sort of kicking off the new year, it's March, not exactly the new year, but starting the year off with just sometimes we just need to maintain. Don't always need big, new, shiny changes, but sometimes just maintaining. And what are things that you can do that we here at LLIS do, working with you and your clients to make sure that policies that everybody takes a lot of time to put in place stay in place. So one of the things that comes into play when clients have an existing policy is making changes to it. Some are fairly easy. Some are a little more complicated. So one of the first things we look at is what's sort of required and what's needed to change an owner or change a beneficiary. So for the most part, and I can probably think of examples that I didn't cover here, but they'd be one-offs and not very common. So things that may often happen is one of the options is that we change the owner from an individual to an individual, a person to a person. Not that complicated to understand. One person owns it and now another person owns it. Many times you'll see this if there's been a divorce decree and maybe the higher earner has some life insurance, but the lesser income or non-employed person now becomes the owner of this life insurance policy. It may have cash values, it may just be a term policy, but at least that way now the new spouse or the ex-spouse can control the policy, name the beneficiaries to probably himself or herself, make sure that it stays in force. So there's an example of where you may change an owner from one person to another, and fairly straightforward. Probably more common is when somebody may want to change the ownership of a policy from themselves to a trust. Most of the time, this will be a revocable trust. Sometimes it can be an irrevocable life insurance trust, but you're moving it from the ownership of me, Mark, personally to a trust. And I do that because then when I pass away, the trust is also the beneficiary. So all the proceeds and assets, or the death benefit from the life insurance policy, flow through as the trust would want me to, or as the trust was set up to pass out the assets. And I forgot to mention, if anybody has any questions, please use that questions box there on the GoToWebinar and ask them along the way, and I'll do my best to get to them as I see them pop up there. The third option is transferring a insurance policy from an individual to a business, or a business to an individual. Individual to a business, probably not that common, but let's say somebody starts working for a new firm and they want to put a buy-sell agreement in place. Maybe the person already has quite a bit of life insurance already, and it's easier just to have the new business own the policy. You can transfer the policy that way. More common would be that a business owns a life insurance policy on an individual. It might be a key man, a key woman, a buy-sell policy, could be a form of deferred compensation or executive bonus life insurance policy. And the business owns it. The business is a beneficiary while the person is working, while the individual is working. And then usually, probably at retirement, the business may say, Mark, you did a great job. We can transfer the ownership of this policy to you. Either A, it has some cash values and those will be taxed to you as ordinary income when you transfer it, or B, maybe it's just a term policy, but they know that my health isn't that great. And so to be able to keep a term policy or be able to convert it to permanent, giving me that policy that I took out 10 years ago may have some benefit to me. And the business says, now that he's retired, no longer working here, we don't have a need for a life insurance policy on him. So what's interesting about ownership changes? Well, only the owner can make changes. Only the owner can change the owner. We might think that's pretty straightforward, but sometimes husbands and wives think that either one of them can change each other's policies. More often, there's a trust, and it may be a trustee, the original donor of the policy and the money and the insured wants to make some changes to it. Well, he or she can't anymore. It has to be the trustee to make any of those changes. So sometimes a little complicated, usually not. Making sure there's a bank account in place. If we're going to change the owner to something, a new trust, a new person, usually here, new trust, then you want to make sure that there's a bank account in place for the trust to be able to write checks from. And up-to-date trust and trustee information. That, again, is not groundbreaking news there, but sometimes it does cause complications when somebody has a trust policy that's set up and the only trustee is deceased. How do you make changes? Hopefully the trust has some provision for that, but sometimes maybe not. So just knowing that having the trust and trustee info up to date every few years will eliminate any complications later, either managing the policy or if it actually pays off the death benefit to the trust. So here's an example. Here's Thelma and Louise. They started a firm. They started ABC Architects. Thelma and Louise thought everything was great, and but then it wasn't. Louise said, I'm out of here. I'm going to drive over a cliff. Well, no, she's not. But I never saw the movie, so I'm trying to remember the highlights of it. But they split up. And now Thelma runs the company, but she also renames it to TJD Architects. So Louise left, and then ABC changed their name, but they didn't change their tax ID number. And they didn't necessarily need to, but they wanted to call themselves something else. Well, later on, they want to change the information on Thelma's policy. And while going through that process, they sent in the ownership change forms, and it said TJD Architects is the owner, because that's what they go by now, with the same tax ID number. So it just caused some confusion that the original owner was ABC Architects with the same tax ID number, and now the forms say TJD Architects with the same tax ID number. So they had to get some court docs stating that the name had legally been changed. Thelma still was the same person who could make changes in ownership. So again, not a big deal, but these are just sort of the little nuances, the little complications sometimes that comes up in our policyholder services team. Things that, again, not a big deal, but sometimes it just takes a little bit of extra back and forth and paperwork to make some of these changes. How about beneficiary changes? So the owner is the one who controls the policy. More often than not, is also the insured. The beneficiary is the one who gets the death benefits. Again, if we're talking life insurance. So you can name different people as beneficiaries. You can name an individual on an application, or to make some of those changes. The insurance company is going to ask for some information about them, including social security number and address. Why social security number? Because if there's a death benefit paid out, then that is reported as to the IRS. Now, the death benefit is going to be income tax free, but if there's any additional interest, that may be taxable. If it's an annuity and a death benefit's paid, there likely will be some sort of taxable gains. So that's reported to the IRS. So that's something that's required there. If it's not at the beneficiary change, it will be required when it's time to pay out the money. So it's easier to have it ahead of time, not when somebody has just lost somebody. Divorce decree, if we need to change beneficiaries for that specific reason, we don't recommend naming minors. A minor, somebody under 18, they can't sign legal contracts. They can't get the money. And so what happens sometimes when somebody does name a minor? So here's a client, he's grandpa, and he had some life insurance and decided that he wanted to leave something to his grandkids, which is great, and set up the policy, did all the right things. But at some point along the line, instead of the trust that he was going to set up, he decided to name his grandkids individually as beneficiaries. And here's what they look like. Seems okay. 3 grandkids. He called the insurance company and said, I want to change my beneficiaries to each of the grandkids directly. Okay, well, what happens? Grandpa passes away. The insurance company, because the oldest grandchild was over 18, is able to pay him $250,000, 1/3 of the $750,000 death benefit. Second oldest, she's over 18, and she got $250,000. Now, if you look at the kid on the right, you probably guess where this is going. He is not over 18. So they weren't able to pay him the money, which again makes sense. Somebody gave me $250,000 when I was 12 or 14, that probably would have been a really bad idea. Would have been awesome, but it probably would have been a really bad idea. And so the insurance company doesn't have a way to pay the money to this child. So it sits there, and it sits. And the insurance company is trying to make contact with him, trying to make contact with the other siblings to see if there's somebody who's been appointed a guardian, somebody who can help with the financial windfall that this child has. Trying to get a hold of somebody. And while that's happening, there's interest accumulating on that $250,000. So when I mentioned why there might be, why they need social security number and for taxes, it's right there, because that's That $250,000 is sitting until it's able to be paid out, and it's earning interest. So eventually, the insurance company was sending out letters trying to get this paid out quarterly for, I think, almost 3 years. Well, eventually what happened is that he turned 18. They were able to pay him the death benefit directly with some interest. But you can see why that little change, naming a minor as a beneficiary, isn't necessarily the best idea. And when you change beneficiaries, you're also going to, so you can change beneficiaries. If you change the beneficiary to a trust, and sort of like we talked about with owners, try to make sure that there's a bank account in place. If I'm the trustee, it's much easier for me to create a bank account for the trust when I'm alive than if I'm dead. If I'm the trustee and I'm passed away and the policy's out there and the insured is still alive, it's tricky for me to set up a bank account. There's probably a secondary trustee and those sorts of things, but much easier to get it all set up initially. Tax ID number of the trust, again, up-to-date trustee information on file with the insurance company. So if someone changes their trust, it's good to know that when that happens. Or can happen at claim time if somebody passes away, but that's the time when you may want the life insurance proceeds sooner than later. It has to be done at some point. It's easier to do it when you don't need it than to do it later when you do. And beneficiary forms can be fairly straightforward. It can be a one-page beneficiary change form, or there can be 8 pages of this change of beneficiary form that covers almost every conceivable option of who. There's a section for the estate. There's a section for corporate, partnership, charity, or trust owned. So these are things that we can help with. If I got the 1-page document, I'd probably be okay doing it myself. If I got the 8 pages and trying to figure that out, I may just throw it in the trash. Well, no, I wouldn't. I'd go through it, but I'd probably have to redo it because I'd probably miss something. So it's let our office help with those beneficiary changes. If you have clients working with somebody else, have them help with that because it can be quite a bit of paperwork. Question: if an estate is organized well and the personal representative knows there is life insurance out there, wouldn't it be fairly easy for the personal representative to put the guardian stated in the will in touch with the life insurance company? And the answer is yes. You would think all of that. And I think we're talking about the grandpa. The problem was we had the grandpa and the grandkids. The hard part was trying to find the parents because they weren't stated in any of these things. So again, it was just back and forth. Had grandpa thought things differently, there probably would have been a better way to make that less complicated. And you know what? Even when we have the best of intentions, some things just go wrong. Some things just don't work out like we planned. And with insurance policies, that's when premiums aren't made, premiums are missed. Something happens and the policy goes into the grace period. So what's the grace period? This is a approximately 30-day window where a policy is technically not in force, but can be put back in force. So if someone has it's just a way so if someone misses a premium payment by 2 days, that it's not automatically done. So what does a grace period look like? Well, one of the things we do to try to prevent policies from going into grace, which means they're about to lapse, which means they're about to be null and void. Grace is sort of the pre-lapse, the pre-falling apart, little window. So we send out our APEs, our advanced premium emails, to say, you have your insurance premium due on 4/4. we're letting you know that this is coming up. We're not attaching a notice. This is not the premium, but just to give you a heads up, because people do go on cruises. People do go on trips. Or sometimes people get a stack of mail and think they've taken care of everything and it just gets put into the recycle bin. So it's just our way of letting advisors and clients know this is coming. This isn't it, but this is coming to have the premium payments due, so be on the lookout for it. So what does the premium journey look like? Well, using our example, the premium is due April 4th, so 4/4. About 30 days in advance, about 1 month in advance, we send our APE email to clients and advisors, letting everybody know this is coming up. Again, we may have spent hours trying to get, working clients have had blood work done, called their doctors because they weren't sending their medical records, done a lot of work to get a policy in place. This should be where we're coasting, but still things get missed. And so we want to make sure that we're sending notes, sending information to people to make sure that the premiums don't get missed. So on 3/4, we send the APE about 30 days early. On about March 20th, the insurance company's going to put the actual premium notice in the mail to the client. So then the client has up until 4/4 to pay the policy and be just normal. That's what we hope to do. They get the notice on the 22nd, put the check in the mail, it's back at the insurance company by the 28th, all set. If the premium is not received by 4/5, so the anniversary date is 4/4, if it's not received by 4/5, it's in grace. There's still time to get the premium in for this little window. So that's really important. We don't want it to go into grace if we can help it. 5/4, if the policy has not been paid for, it lapses. So like I said, we sort of, there's the policy date of 4/4, there's a 30-day, time to get the money in. Policies, you could do that, no blood, no foul, just time to get the money in. So you have a 30-day gimme on making those payments. On 4/5, 1 month after you were supposed to have it done, which, most things probably is pretty generous. 30 days after something was due, you still get to turn it in. I didn't get that in college. If you had to turn something in on Friday, you had to turn on Friday. You didn't get to say, let me turn that in 3 Fridays from now. But after 5/4, the policy has actually lapsed. It's now truly non in effect. So what happens after 5/4? To try to put the policy back in place goes through a process called reinstatement. And I'm going to touch on this, give 2 examples here in just a minute. But what is reinstatement? Reinstatement is asking the insurance company to put the policy back in place so that it keeps the age which the policy was issued at. It keeps the rate class. It puts the same policy back in place. It's not a new policy. So if the policy's 3 years old and it's a 20-year term, putting it back in place, I still have 17 years left. I usually have to apply some sort of application. It can be extensive, and I'll go through that here in a minute. And I also have to pay back premiums. So let's say in this example, I didn't go through the reinstatement process till July 4th. Once I pay my premium, it puts the policy back in place as if it was 4/4. Make sense? I think I'll touch on that here in just a little moment too. So how do reinstatements work? Let's look at one example of a client I helped. Had one question: is there medical underwriting with reinstatement? Great question. We'll go through that here in just a second. So this was a client's term policy, and it was owned by a trust. The insurance company received the premium on November 7th of last year. On November 27th, the check was returned by the bank for non-sufficient funds. So on the 28th, there was a letter sent, and this is sort of that, the intent was to pay the premium. So there was just not, it wasn't just radio silence and you had no idea. They meant to pay the premium. So there was a letter that said, as long as we get the check in by 12/27, then it's almost like it's like a double grace period. Rare, but as long as you get the premium in by 12/27, we'll consider it in place. And the trustee sent a second check, but it was never received. And insurance company looked here, there, and everywhere, never found the second check. So on 1/2, the policy had lapsed. Actually, on 12/27, the policy lapsed. So at that point, we worked with the client and submitted the reinstatement application to the insurance company, which is pretty much a full application. So to the question about, is there medical underwriting with reinstatement? There can be. So first off, there's a full application that has what medications are you taking, who's your primary care physician, that sort of thing. Many times, the insurance company is going to require new lab work, which can be the blood work and the urine specimen, and require medical records. So to that point, it's like the full new medical underwriting again. The policy has lapsed. You're trying to ask to put it back in place. The insurance company wants to say, are you still insurable? So luckily with this client, because it was recent, after looking at the applications, the insurance company said, we'll consider with the application and getting his most recent physician's records, because he saw his doctor within the last month. He had blood work done. We're going to say that's good enough at this point. No exam. So I was very excited about that. Insurance company received the doctor's records on 2/12, and the good news is that the reinstatement was approved. So remember where I said you pay back premiums? Paid the full years of premium to put the policy essentially back in place as of 11/7. And so the next check will be due 11/7 of this year. It kept the policy as if nothing different had happened. So hopefully that answered the question about medical underwriting with reinstatement. Another question, how long after the lapse can reinstatement be initiated? I've seen up to 6 months. And at some point, the farther out it goes, so in this example, the reinstatement worked with just the medical records because it was very recent, and there were recent doctor's records. If a policy had gone out 7 months, 8 months, then we know that the company is going to want all new of everything. And at that point, then we wonder, are we better off trying to reinstate a policy, or is a client better off trying to apply for a new one? Because by that point, they may pay almost a full year's of premiums to put something back in place. And if they're still in good health, have good lab work, good doctor's records, all that, then is it better actually to just re-underwrite with a different policy, a new policy, assuming they're in good health? Here's another example, but this one didn't work out so well. So there was a client, and through 2017, 2018, client had a general history of the ETF, so that's the automatic bank drafts, being returned for non-sufficient funds. When you have your annual premium return for non-sufficient funds, usually write another check and move it around and it's okay. The monthly for non-sufficient funds is tricky because it's coming so monthly, it's monthly, that it's hard to keep track of where a policy is in the process. So 10/28, Premium was returned for non-sufficient funds. We sent the grace email. Policy has gone into grace. Paid the monthly premium to put it back in place as of 10/28, but it was already back in grace because now it wasn't paying current monthly premiums. It was just paying the last monthly premium. So you see how this is sort of a circular thing. It's you're always getting the grace, but you're not keeping it current. You're always paying just to catch up. 12/13, another grace email sent. Policy lapsed. 12/20. Really did lapse that time. Sent the reinstatement form to the client on 1/11. Received a decline letter from the reinstatement. It says, regretfully, we cannot approve every request for reinstatement. We must inform you that our underwriting department has declined reinstatement of your policy due to unadmitted prescription history. 2017, I'm not even going to try to say some of those. I could try, but I'm sure I would get them wrong. So here's an example where someone, since the policies were taken out, was starting to have a prescription drug problem. I think the worst part to the underwriter is that it wasn't admitted on the form. And so if they're finding something that you're not admitting at that point, what other things are you not admitting throughout the process? And so the desire to reinstate a policy for someone who's not admitting to fairly significant health information starts to open the question, what else are they not divulging? Probably don't want to reinstate this policy. How do we protect on lapsing? Well, here is a chart, and I like this one because it shows the lapse rate by payment mode. And this sort of verifies what I've known anecdotally for a long time. For the first, and you'll see spikes in the lapse at 10, 15, and 20 years, and that's just the natural course of a 10-year term policy dropping off, a 15-year term, a 20-year term. But if you look for the first 9 years, annual, semi-annual, and monthly payments have a very low lapse rate. I mean, they're almost identical. Right above it is the quarterly. Almost 4 times initially lapsing. And here's how that might go. I have a policy, and today's March, but we backdated a policy to the end of January to save my birthday. So I pay a check. I write a check. It's for a quarter. Put the policy in place. 3 weeks from now, I get a premium notice because now my next quarter is coming up. Well, I think I already paid that because I just did. So I don't pay that one. The policy lapses. So you can see that a little bit. Very little do I do anything on a quarterly basis. But almost all my bills come in monthly and some come in annually. Quarterly, there's just not a lot in life that I do on a quarterly basis. So most of my life is not based on quarterly, and I don't think most people's is either. So you can see the lapse rate for quarterly payments is much higher than any other option. It also can cost more. So when you pay more often than annually, you're going to pay an additional amount each time you make a payment because there's additional costs for billing twice a year, 4 times a year, 12 times a year. If you're paying by a bank draft, there's additional charges there. Additionally, the insurance company, part of what they do is earn interest. And if they have $1,000, they earn interest on that premium all year long. If they're only going to get $500 twice a year, well, then they can't make as much as on the $1,000 because of interest. So to even that out, there's a modal factor of 0.52. So if I pay $1,000 annually, or I can pay $520 semi-annually. So it turns out 4% more than annually. Quarterly, it's usually 2.7 as a modal factor. So you pay $270 4 times a year, $1,080. On monthly, the modal factor can be 0.008. So 88 times 1,000, times 12, 1,056. So some companies you can actually pay less per year by doing monthly, where you think that would be the opposite. But monthly premiums, except for our last guy who just didn't have enough funds in his bank account every month, monthly premiums, because they're coming out automatically, are very unlikely to lapse. So there might be a little savings monetarily there, but also headache-wise. A collateral assignment. This is something, and this seems to go in spurts here in our office. And anytime you have clients who may be taking a loan, the Small Business Association is a good example, where someone is taking out a loan to buy a business, improve a business, build up inventory, whatever it might be. Sometimes the bank wants life insurance to back up that loan. So if something were to happen to your client and they took out a $100,000 loan, the bank may want a collateral assignment or want to be the beneficiary / collateral assignee of the life insurance policy, so that if I were to die, the bank gets paid back. So what sometimes people think they want to do is name the bank as the beneficiary. You don't. You want a collateral assignment, which is essentially a lien, a piece of paper against the life insurance policy that says, if I were to die, the insurance company sees that, and then they see a note that says collateral assignment, that says somebody has rights to this death benefit. They take a look at that, and then they can pay out the amount of the loan that's still outstanding. That's important, the amount of the loan that's still outstanding. So Brad, here he is. He took out $1 million life insurance policy because he took out $1 million loan. He can do whatever he wants with it, but took out $1 million loan. But the bank said, we want a life insurance policy for $1 million. So we worked with him to put a collateral assignment on the loan. What happens is Brad goes along, he pays the debt down to $600,000. He's been making his payments for a while, and he passes away. What does a collateral assignment do? Well, when Brad passes away, there's that $1 million life insurance policy. The insurance company looks and says, wait, I see a collateral assignment. It's collaterally assigned to Bank of America. And there's a person's name there. And they're going to call that Bank of America branch and say, hi, we see that Brad passed away. I show that there's a collateral assignment for the loan outstanding. And the bank is going to say, yes, he's paid the loan down. The outstanding balance is $600,000. So the insurance policy is going to pay the bank the $600,000, which is the amount of the outstanding loan. And then the policy is going to pay whoever the named beneficiaries are. So again, it's that collateral sum is like a lien. I'm going to pay the beneficiaries, but I have to pay any of these collateral assignees first. The beneficiaries get the leftovers. So in this case, his wife Stephanie gets the other $400,000. And because it's a life insurance policy, it's tax-free. So the collateral assignment just sort of creates a hierarchy of who's going to get paid that policy. What if Brad hadn't done a collateral assignment? What if Brad had done it himself, maybe thought he knew what he was supposed to do, maybe called the insurance company directly and changed it directly to the bank? Well, when he passes away, the insurance company doesn't know to do anything but pay the bank the $1 million. There's no other this example, there's no other beneficiary. There's a $1 million life insurance policy. The insurance company has to pay it. They pay the bank $1 million. And the bank says, whoa, he only owes us $600,000. What do we do? Well, now it's an asset of the bank. The bank then might give it to Stephanie, but there can be all kinds of problems with that. Maybe it's taxed. We don't know exactly what that's going to be and how that's going to work out. So you really want to not have that happen. if you can help it at all. So that's what the collateral assignment does. It creates these levels instead of just naming one person 100%. And like a lot of things in life, there are some ideas that, we just try things, we try it out, see if it works. And, sometimes they don't always. But we want to have options on what those are. Clients with life insurance policies that are permanent life insurance policies, so variable UL, universal life, whole life, more so universal life and variable here in the next examples, have two options to take money out of their life insurance policies. They can take withdrawals. So a withdrawal pulls money directly from the cash value. It actually reduces the cash value and it reduces the death benefit. So if I have a $1 million life insurance policy with $200,000 of cash value, I take a $100,000 withdrawal, and when I take my withdrawals, it's up to my cost basis out first. I take $100,000 withdrawal, my cash value actually is reduced to $100,000, and my death benefit is actually reduced to $900,000. I actually canceled $100,000 of my life insurance. Or we compare that to a loan. Now with a loan, it doesn't actually affect the death benefit until the time of death. So if I take a $100,000 loan in my same example, the death benefit still remains at $1 million. But if I die, the loan is paid back through the death benefit. So my beneficiaries would get $900,000. If I took out a $100,000 loan and then cashed the rest of the policy in, I'm just going to get the $100,000. I had $200,000, took out a $100,000 loan, I canceled the policy, I get the remaining $100,000. So if I die or if the policy is canceled, then the loan is paid back either through the death benefit or the cash value. But what are those words there? If not paid back. That's a nice thing about a loan. When I took that $100,000 withdrawal, I truly reduced my death benefit. I actually cut it by $100,000. I can't get that back. When I take a loan, all I have to do is pay back the loan and the policy is put back in place. $1 million, $200,000 of cash value. I've charged interest, but I have cash values growing. I have loan being charged interest. A lot of policies after 10 years, money in the loan account may earn 3% and be charged 3%, so they call it a wash loan or zero cost loan. And when I die, the loan is paid off through the death benefit, but again, I can pay back the loan. So that adds some flexibility to the loans that you don't get with the withdrawals. So here's some clients that called us just last week, Doug and Gloria. Well, they're getting to that age where they want to downsize. Had the big home with kids, actually found a smaller house they like, a little more affordable. They're excited about it. And they called us because what they want to do is see if they can finance sort of this bridge loan themselves. Rather than having to pay lender's fees and all these other things, they want to be able to pretty much take money out of the policies to buy the new house and then pay themselves back when they sell the old house. So they called and said, in Doug's policy, he has about $900,000 of cash value. Can he take an $850,000 loan? Yes, he can. Still plenty of money left over in that policy to do that. Gloria, $400,000 of cash value. Can she take a $250,000 loan? Yes. Yes, she can. So for hers, $250,000 to $400,000, that's a pretty big loan. Proportionally, his is huge. Taking an $850,000 loan on $967,000 cash value. Long term, that would not keep a policy going that requires that much sort of cash value. The good news is they expect all this to wrap up within the next 90 to 120 days. So they're taking the loan against the existing policies, but when the old house sells, they want to pay all this back. So it's much more flexible. They can do that with a loan. They couldn't do that with a withdrawal. We work with a lot of you and a lot of your clients on term life insurance. And term life insurance is fantastic. I own a few term policies. I know what term can do. It's a low cost. It's a way to provide a lot of death benefit in case something happens. And we can time it to different term lengths, 10, 15, 30. Some companies even now have a 35 and 40-year term policy. So we can time it to different life events, retirement, kids being out of the house, kids being out of college, mortgage paid off, all these different things that we can do with term. But because of the word term, that means there's a limit. There is a certain term of time where this premium, this guaranteed level premium is good. And then after that, it's not. So what's a way that we can look at policies and make sure that with term coverage, we layer in some options? That's a conversion. So what's a term conversion? It's a contractual right built into a term policy that allows you to exchange your term policy for permanent coverage. So that can be universal life, whole life, and then flavors of that like variable universal life. But you trade your term policy for a permanent policy with no health underwriting. If you're still in great health, so if somebody has a 20-year term policy, it's coming to the end of the 20 years. If someone wants permanent coverage and they're still in great health, it may be a good idea to look around because you have the universe of permanent life insurance companies out there. If somebody's still in good health and they just need it for another 10 years, they just want to buy a new term policy. But if they're not in good health, the converting with no health underwriting to the same class that they were issued 20 years ago is very valuable. So that's the benefit to conversion. I'd say every once in a while, somebody's going to have a term policy and the conversion policy that they have with that policy is the same as they might qualify for, new underwriting. It just happens to be the best rate. But more often than not, somebody else might have a better rate for this, that, or the other if they're still in good health. But if they're not in good health, the conversion option is very valuable. Keep the same health class, but it converts at your attained age. So if you were 40 when you got the 20-year term policy, 20 years later, you're 60. So you can still be preferred today because that's what the original rate class was issued at, but your premiums are based on your current age, 60. Again, just makes sense. Can't go back in time. Through some specified term to some maximum age, it's usually the length of the term period not to exceed 70 is, I would say that's 80% of companies. A few go to 75. One or two I can think of go to 65, but it's about that age. And one of the things that we recommend is the term through the full level term period. There are some companies out there that have a term, call it a 20-year term policy, but it's only convertible for 10 years. Or maybe a 20-year term policy that's convertible for 16 years. If somebody's faced with the option of paying $500 for another 4 years or converting to $4,000, probably never choose the conversion option early. But if you don't do it then you lose that option when it actually hits the end of the 20 years. And it's no financial underwriting either. Don't have to justify that you're making a lot of money anymore like you would with the term when you were taking it out. And another thing we do here in our office to help you and your clients is reach out when clients are coming to the end of the term policy. So here we have one of our notes, notification of term expiration. Records show that your principal term life policy will reach the end of the level term period. So policy is going to expire, the term premium is going to come to an end. What can you do? Well, if you just need term, let's look at a new term policy. It's going to be less than converting to a permanent coverage. Term is almost always less than permanent. Well, term is less than permanent if you're still in good health. If you're not in health, if your health has declined, maybe we should look at converting the term to permanent if you still need coverage. But if you don't need coverage, great. My hope is that when I get to the end of all my term policies, I look at my financial situation and say, I don't need these anymore. My income, I earned my income, I saved for retirement, I saved for college, my kids are out of the house. I don't need this anymore. And so maybe I want to convert it just for fun, have some permanent coverage, but as a need, maybe my hope is that I don't need it at that point. Don't have to make that decision. I can just say, you know what, I'll just let it drop. I don't need the life insurance anymore. So all of those are options there at that point in time. So let's look at an example of conversion. Here's one. Client's 37, term policy issued in 2006 at standard rates. Came to us 10 years later, his 10-year term policy was expiring. Doesn't need as much, needs $150,000, but needs it for about the next 15 to 20 years. Based on changes in health, overweight, diabetic, a new policy would be at a table D. It's a substandard rate class. And so a new 15 or 20-year term policy is going to cost $1,300 or $1,500 a year. We looked at converting his original term policy. Usually when we think about conversion, we think about making it last forever to 90 to 95 to, whenever I pass away. Here it's just a short-term need. We're able to convert his term at the standard rates, which is better than the table 4, for $150,000, and annual premiums less than $1,000 a year. Now with this particular universal life policy, if you paid the $59,590 for the next 23 years, it was projected to last, guaranteed to last at least 15. So saves money, quite a bit of money every year, and gets him right in that target length of time that he was looking for. Another option of a conversion, John and Daniel, they each had $1 million 20-year term policy. They were brothers, and they had these policies as a buy-sell to fund a buy-sell agreement for each other because they owned an office cleaning service. And so they owned this. They were the people out there meeting office building owners, try to get them to use their services, and the term was expiring. We worked with the advisor and the clients, looked at getting new term policies. John, we were estimating a preferred rate. Daniel had, since the original term policies been taken out, had some problems with alcohol. And so based on information that we had from him, we did preliminary underwriting checks and estimated a table F or table 6. So that is 6 notches below a standard rate class. Going to be quite expensive to go through underwriting. What they wanted to do is just convert the existing policies they had because they were both issued at preferred, and because they're brothers, no plans on buying each other out or just basically working in the business until it runs out. They wanted to convert those policies and have them run through their ages 95. And we do all of these things, the owner and beneficiary changes, to make sure policies go to the right people when they need it. We want to make sure policies don't lapse so that if somebody does need it, the life insurance there is in place. And so the claim time is sort of the culmination, the why we do all of these different pieces, because we hope we don't need it. We hope term insurance that we never need it. I hope that I pay my disability premiums every year and I don't have to need it. But if I do, then we get into the claim situation. So we do all this work to keep policies in place because we want to make sure your clients' policies are in place if they need it. And we look at this one particular client just to give an idea of sort of the claims process and what people here in our policyholder services team can help do there too. So in 1971, Tony was born. In 1971, the voting age was lowered to age 18, and the Dow Jones closed at 890. Whew. Along the way, Tony met Brandy. They fell in love. They had a son, and I helped Tony get, along with his advisor, get 3 life insurance policies. We did a term layer for him so that as time went on, the amount of coverage decreased as he met certain financial goals. Unfortunately, he didn't make that first term cutoff. He wasn't able to meet his financial goals because in 2015, he died in a boating accident. So what happened from there? 12/15 was when he died. On December 21st, the advisor called our office and we confirmed that his and Tony's, confirmed for the advisor and Tony's widow that all 3 of those life insurance policies were paid and in force. So that's the first thing we want to know. Are those in force? December 22nd, we emailed policy info to the advisor along with claims forms. January 26th, advisor sent us a note. He talked with the wife, or the widow. She's been in contact with Cincinnati Life and mailed all of the needed claims forms, death certificates, etc. On February 3rd, death benefit was paid. So very short period of time when all the things are there. But that's the importance of making sure that policies don't lapse. These are the times when we hope we never need it, but if it's there, that's why we work so hard to keep these policies in place. And we got this note from the advisor a little ways after. Brandy received the life insurance checks. Thanks for your and your team's help. Terribly unfortunate situation, but glad we could partner together and make sure their family was covered during this tough time and for many, many years to come. Because he had that life insurance to protect those income earning years. Unfortunately, he didn't get very many income earning years from when we got the policies. So it did exactly what it was supposed to do. And so if you have questions about any of these topics, anything to help with your client's life insurance policies, ownership changes, beneficiary changes, we have our policyholder services team, Taylor on the left, Ashley in the middle, Neva on the right. And so, and recently we've just added a mod to our policyholder service team. So we actually have 4 people in our office who work just with you and your clients on these types of things to keep policies in force, in tip-top shape, in case they ever need them. And I have one question. So when converting, the face amount can be reduced. So yes, absolutely. If there's $1 million term policy, comes to the end of the term period, end of the 20 years, you can convert $1 million down to whatever the minimum of that policy is. Most insurance companies, it might be $50,000 or $100,000. So yes, you can always convert less than the full amount. And the premium can be based on a period certain. Yes. So if it converts to a whole life policy, whole life is a fixed premium. So if you convert a $250,000 whole life policy, it's going to be X premium. There's not a way to choose that necessarily. If it's a universal life policy, there may be some more wiggle room. I want to pay just enough to keep it going 20 years. I want to pay enough to keep it going to age 100. So a little more flexibility there. So hopefully I answered that second part of the question right. So for those of you who might be new to us or haven't listened to our webinars before, so we do sort of a David Letterman, which I realize the more time goes on that fewer and fewer people remember David Letterman. But the top 10 things that make LLIs different, one of the first things is monthly webinars for free, just like this one. And so we do the 10 over the course of the year, so you all can get your 10 CFP, 10 of however many CFP credits you need for the year. We're not your competition. We only work with fee-only financial advisors. We work really hard to save you time and your clients money. One of the ways of doing that is pre-underwriting, getting a lot of health information about your clients before we ever submit an application to an insurance company to make sure we find the best fit given all the information that we have. Lots of advisor tools and client tools on our website. And if you find things out there that you say, Mark, I really wish there was this, then I'm sure you're not the only one who thinks that. So a lot of things we design based off just what advisors ask us for. So if there's something out there that you think would make it much easier to have conversations with your client or advisors might find helpful, please let me know. We're a proud sponsor of a number of different fee-only financial planning associations. We speak at the conferences throughout the year, host webinars, and it's just a great group of people to work with every day. We have specialists in different areas for needs for your client: life insurance, disability insurance, long-term care, annuities, hybrid policies, that's long-term care with a life or annuity component. And like we just talked about, we manage your clients' policies now and in the future with our APE, Advanced Premium emails, and the notes, the notification of term expiration. We do our best to keep you in the loop when things are happening to clients' policies because, like I said, we set them up. That somebody's had a bad turn in health, conversion is a very valuable thing to a life insurance policy, so wouldn't want to let it lapse accidentally. And Alice is the secure advisor portal. A lot of neat things out there, and we're always looking for, again, suggestions, things that you all would think would be helpful, ways that we can improve it. And it's ever changing, but that keeps Dave, our IT person, busy. So any other questions? I see too, when converting, the face amount can be reduced. Yes, I think I answered both of those. Somebody asks, you pay higher premiums to make premium payment monthly? So yes. So in my example, and let me see if I can find that here really quick. Try not to look at the screen if you get car sick. Here we go. So an annual premium is going to be the least amount of any policy. And so in this example, if you pay $1,000 annual premium, the annual premium is $1,000, that will be the smallest amount. When you pay more frequently, there are additional, they call it a modal factor, but it's some amount that you multiply by to get the amount. So in semi-annually, the modal factor is not 50, or else you'd pay $500 twice a year. If I had the choice of paying $1,000 annually or $500 twice a year, I'd always pay $500 twice a year because I got to keep the $500 at the beginning of the year and I got to earn the interest. So the insurance companies say, well, it should be really 5.2. So I pay $520 twice a year for the total of $1,040. Quarterly ends up being more than any of those, $1,080 over the year, and the monthly 0.008. Sometimes I've seen 875. Actually, I think it's 0.0875 or 0.08, not 0.008. But either way, $88 a month times 12 is 1,056. So you still pay more for any option besides annual, but here what you can see is actually by paying monthly, you pay less over the course of the year than paying quarterly, and quarterly is the one that's most likely to lapse. I'm a much bigger fan of monthly payments. So thank you for that question too. All right, I don't see any other questions. It's after 5. It's still daylight, so that's always throwing me off a little bit, but it's after 5. I hope everybody has a great rest of your month. Thank you for tuning in, and like I said, any questions, anything that we can do to help you all, please don't hesitate to email me or give me a call. Thanks.